Trading with the moving average crossover. Somewhere in the last 30 years of trading, I used the moving average crossover system to trade with. And it's actually quite a useful system, but what you have to understand about the moving average crossover is it's a lagging indicator. And do you really want to be trading with lagging indicators? Used many indicators in my time. I've tried many different indicators in my time and they've all been useful. Every single indicator that's available out there, every single system on the squiggly lines that's available to you out there actually works. The disadvantage of the markets is not the squiggly lines, not the systems, it's the traders. The traders are the ones who get it all wrong on a regular basis. So what I'm going to talk about today is how to trade with a moving average crossover system. I'm going to show you how to use it. I'm going to go to the charts and we're going to go through the process. But after we've been to the charts and after I've showed you how to trade with a moving average crossover, then I'm going to actually show you how you can become a profitable trader in the stock market, how you can actually apply systems and strategies so that you can actually make money. Because I'll bet you've paid thousands of dollars for a course. Well, maybe you haven't. Maybe you only watch the free videos like these ones, but maybe you've paid for a course. Maybe you've read a book. Maybe you've studied the stock market. You're interested in getting into this game. Or you've been in the game for a few years and you haven't become profitable. And you're wondering why that is. You've used all these systems, you've tried all these different methods, and none of them have made you into a profitable trader. And you're probably wondering, what the hell? How is it possible that I can pay so much for a course, that I can do so much training, I can learn so much about the markets, and I still can't make money? Well, it's actually quite simple, really. You know, trading is risky. And if you don't like risk, you probably shouldn't be trading. But at the end of the day, the market's a 50-50 game. It's always going to be a 50-50 game. The squiggly lines don't make you money. You see, 60 to 80% of traders lose money on 4-hour and daily time frames and position trading. 99% of traders actually lose money on 5-minute trading. And you'll be thinking, why? Why is that? Are the systems not working? Is there something wrong with the squiggly lines? No, there's nothing wrong with the systems. They've all been backtested by some pro. Somebody's gone out there and worked out these systems and worked out that all of these systems work. The main factor to why people are losing in the markets is actually quite simple. The main factor is you, the trader. It's the traders that are the factor. It's all about how you apply the system to those squiggly lines at the end of the day. Nothing else. So every system out there works, right? Really? I mean, is that actually possible? Yes, it is. You know, when I tell you that there's that 60 to 80% of traders are losing money, you'll probably say to me that's because many of the systems don't work. But actually, they all work. But how you apply these systems with your gut feel and how you apply these systems to make them work is really, at the end of the day, entirely up to you. And after the charts, I'm going to explain to you how to approach the markets in a way that will make you profitable. Guys, pop down to the description, get your free Forex book. It'll explain a little bit about trends and that sort of thing. And perhaps if you want a funded account, there's one there for you as well. Without further ado, don't forget to join as a member so you can get trade of the day every day. That's a bit of fun as well. Let's go to the charts. Let's go and have a look at the charts. Let me show you how to trade with the moving average crossover system. It's very similar to the MACD, moving average convergence divergence, but the moving average crossover system is a little system on its own. So you all know that I don't use indicators at the best of times. But I'm showing you a moving average crossover system just in case it's a system that you want to use, it's a system that you've tried to use, and also just to give you insight into how the systems work. Fibonacci and all these, I did Fibonacci last week and now we're doing moving average crossover. Now I'm going to show you the moving average crossover, and the first thing I want to tell you before we start is understand that it's a lagging indicator. So by the time that something happens, it's already happened. So it's your entry is going to be late and your exit is going to be late on any given trade. But it's a strategy and it works, and it's a system that it actually works. In the 30 years that I've been trading, I've used it once or twice, tried it out, and it does work. It doesn't not work or anything to that effect. It's just a question of how you use it, why you use it, and is it something that you prefer to use. It's always, like I say, it's about how you approach the market. It's got nothing to do with the squiggly lines at the end of the day. But what this is, these are two moving averages that I've put in here, and this is one of the best ways to actually get your trading on a 4-hour chart or a daily chart. For investing, I use a 50-day and a 200-day moving average. But for trading, what we're going to use is a 9-day moving average. Why 9 days? Just works that way. And a 20-day moving average. The 20-day moving average, it's a couple of weeks, and that also just it works well that way. You can choose what works best for you. Now, on the 4-hour charts, I find the 9 and the 20-day, and the daily charts, the 9 and the 20-day work the best. Now, the system is basically this. When the 9-day crosses through the 20-day, that's a buy signal and you can buy. But the trouble is, when it crosses through, it's already up there. So your profit is minimal, right? And then if it crosses back through the 20-day, that's a sell signal. And that sell signal's all the way over there already. So you've kind of missed the boat. But okay, no big deal. Now you take a sell when it crosses the 20-day here. Maybe this is your first trade. Then you would have got quite a reasonable profit out of a trade, such as this one. So as it crosses over, goes through the 20-day, you get into the trade, you get all this profit, comes back out, crosses back out again. So there you've got your sell signal. But the thing is, you've only got this little bit of profit in the middle here. Had you used price action, you would have got the entire move, the whole length. So price action is a much better trading strategy than the moving average strategy. But if you feel like you want to use the moving average strategy to be more comfortable in the trades, then there's nothing wrong with using it. If you'd taken this trade here, you would have got your buy signal here, which is somewhere around here, and it would have given you the buy all the way up to there. The sell signal is back down here. So you're only getting this tiny little piece in the middle. Just remember that. You're not getting this whole move. It looks like you're getting the whole move, but you're actually not getting this whole move. Here you would have sold. You would have gone into a sell and it would have brought you down. Don't add this into your price action too much, because it is going to confuse you. It is going to stop you from taking trades. So at this point, this product would be short. So you'd be sitting in the short, and if it crosses over and crosses back over the moving average, the 20-day moving average again, it starts going up, then it becomes a long trade. And it kind of shows you when structure's changed or when structure's broken or something to that effect. Let's have a look at another trade. This is the Japan 225. Now, we've actually traded short into the Japan 225. We've already traded short into this actual trade. And now if you look at this, we traded short much higher up, somewhere around this level up here in price action, because we've seen the short take effect. And effectively, this 9-day moving average hasn't even crossed over the 20-day moving average yet to give us the short trade. It might just be a failed trade, because that's the downside to price action. You might get a failed trade, but it's almost there and it's going to cross over. But if it does cross over and say, oh, this is a short trade now, look how late you are into the trade. You're actually pretty late. Let's have a look at one of our other trades. This is Wall Street. We've taken Wall Street to the long side because it's in this demand area over here. So there's a demand of money here. So we're looking at going long on Wall Street. And while it does look like it's against the trend, if you start going to the daily charts and you start looking at the overall picture, it's not against the trend. But there is a structure here of this going down. So there's a good likelihood that I'm wrong and this could go down and break through this level and carry on down. But I see a bunch of money here, so I've gone long. And you can see that the 9-day moving average is pointing short. It hasn't even turned around and looked to go up yet. By the time this turns around and crosses the 20-day moving average, if this goes in my favor, you'll already have lost quite a bit of money, and you wouldn't have gained all this area here. So while the system works, it is a very, very lagging indicator. For example, here you would have taken your long trade somewhere at the earlier levels, and with this crossing over here, you would only have taken it somewhere up here. Yes, you would have made a profit, but you could have made much more profit. That's why I say these trades are much more complicated. when it comes to making profit. Let's have a look at the US 500. So this is the US 500. Now, look at what you're getting here. You've had this long move. Now, this is where you would have made money on a move like this, where you would have gotten into the trade at that cross somewhere up there, and you would have made all the money up to here. But where do you get out? Do you get out here? Look, it came back up and went back up again. It is looking to cross back down. Do you sell here? Is this a sell? Very difficult one to call, isn't it? So the moving average crossover is not a perfect system because you never can, because if I look at the US 500, this is a very bullish product. And is it going to fall over here and crash down? In all likelihood, most likely not. In all likelihood, this guy's going to turn around and head on to the upside. But if I look at the moving average crossover, it looks like it wants to cross over. So whatever you do, if you do take trades with the moving average crossover system, don't preempt the trades. Don't take the trade before the moving average has reached, because sometimes it won't reach and it'll turn away. For example, like it's going, looking there, turns away and goes down. See, it turned away there and it's gone away. So you've got to wait for it to cross over before you take the trades. At least with the moving crossover system, you don't have to wait for any color candles. You don't have to wait for any positivity. You just have to look at the moving average crossover, the other moving average, and it gives you the direction. The reason I'll use it, for example, in the investing scenario is because I'll use a 50-day and a 200-day moving average, which is a very, very long-term system. And all I'm looking at is if the 50-day is above the 200, that's the golden cross up, then the stock is bullish and it's probably a good product to buy. And if it's below, then I must just do more research because it's concerning and it might actually be quite weak. So that's the moving average crossover system. I will do the MACD as well soon because the MACD, the moving average convergence divergence, is very similar to this. Also a lagging indicator, but also quite an interesting product to learn. So that's just so that you guys know how this works, because it's good to know how the other systems work in the market besides the price action that we use. But keep it simple, stay with price action. This is just for your information. Now you've been to the charts. Now you've seen the system. Now you've seen another system that you can trade with. Now you know that I don't trade with these squiggly lines. I mean, with these indicators. And the squiggly lines for me are just a high probability trade. A high probability of what might happen next in the markets. That's what I'm about. That's all that I think about is if I look at a squiggly line, I see traders. I don't see the lines. I see what are traders doing behind the scenes? What are they thinking of doing next at the end of the day? And that's, if you start to see that picture, it starts to change the way you look at the market. So the way I look at it is actually quite simple. I say, all right, let's say I've got a $100,000 account. Let's say I got a $5,000 account. Let's say I got a $1 million account, but I'm going to use $100,000 as a round figure. And the main thing to do is to risk 1% on every single trade. Risk 1% per trade. So in other words, risk $1,000 per trade because you've got a $100,000 account. Don't change that amount as your account grows. Just keep it as you're risking on a $100,000 account, even if it grows to $200,000. Only when you're ready to make it a $200,000 account do you play it as a $200,000 account. So you're risking on $100,000. So every single trade you keep the same. You don't change the amount that you're risking. This is your business plan. You don't have to write this down. It's not rocket science. I mean, really, why would it be rocket science? Why would it be difficult? It's really simple, but it's difficult to apply. Because what you find is no matter how many courses you do, no matter how many videos you watch, no matter how much information you get and how easy it looks, the minute you put real money in the markets, everything changes. It suddenly becomes so much more difficult. It becomes so much more, impossible to take these trades or, to follow these trades or to follow the winners. And this is where it gets difficult. You've risked $1,000 on the trade. Now, how do you risk that $1,000? Well, firstly, you go and you look for an invalidation area where if you were to look at that trade right now, you would think, you know what, I'm not going to trade this because it looks rather bad. You look at the trade and you think, nah, this is not for me. If that's the point, then you look at that point and say, well, if the trade got to there, that's the point where I'd say this trade is no longer valid for me. There's no point in being in it anymore. Then you take that level back to the cost and you work how much $1,000 is back to that cost, right? So that's how many contracts or pair or puts or points or whatever you want to call it you can buy. That's it. Now you buy that amount of the trade with a view to it making 2 to 1. So in other words, if you're risking $1,000, you want to be making $2,000 profit, if not at least 1,500 or more than 2,000. So you want a decent profit level on your trade. You don't want like $50 profit for $1,000 risk, because that's meaningless. And as I always tell you guys, a win rate is meaningless, because a win rate and all 10 trades make $50 is just a waste of time. Every single trade has to make more than it's risking and make more than you're losing, because you're going to win 5, you might lose 5, right? So you want to make more on your wins and lose less on your losses. That's why you're keeping the stop loss the same across all the trades. Now the difficult part comes in. Now the difficult part is, how do you follow that trade all the way to $2,000? How do you follow that trade so you can actually make a win? Because you know what's more difficult than actually going into a loss is going into a small profit. You're $300 in profit, and I'll bet you every single one of you out there is $300 in profit. You've got your finger on the sell button. You're clicking sell, sell, sell. I need to get out of this now because I'm in a profit. I'm making money. It's time for me to go. All of you are out there doing that. And that's the difficult part. That's the mistake. So look, it's easy. When it goes into a loss, leave it alone. And if it goes to the $1,000 stop loss, don't move the stop loss away. Just leave it. It takes it, move on to the next trade. That's the easiest thing you can do. I know you're all itching to dollar cost average. I know you're all itching to move the stop loss away. I know you're all itching not to take the loss. Take the loss, walk away, move on to the next trade, start again. Now it goes into profit, and it goes $300 into profit. Do not click sell. Put your hands under your butt on the chair and just sit on your hands, okay? And just leave it alone. In fact, that's why I actually trade 4-hour charts, is because I can walk away and I don't look at the charts and it doesn't worry me. I'm not worried about what's happening with the trade. And then I'll check on it later on and see what's happening. Because if you sit and look at the charts all day and it goes a couple $100 into profit, do you know what you're going to do? You're going to take the profit. So leave them. Walk away, let it run. Now, when it goes $500, $600, $700 into profit, then you've got to take that stop loss and move it up to cost, or maybe $100 or $200 into profit if you feel more comfortable with that. Now the trade is not costing you $1,000 anymore. Now the trade is completely free. Now you've got a free trade. Imagine that. You don't have to pay for it anymore. No matter what happens, you either break even or make a small profit, but no matter what happens, you haven't lost anything. Why do you all think that if you're $700 in profit and it comes back and takes you out at break even, that you've lost $700? Because you've lost nothing. You haven't cashed out. But yet, if you go into a loss, you'll dollar cost average down. You'll add to the trade because you want to stay in the trade because you don't want to lose anything. So what are you telling me? That if you are in a loss and then it goes back to break even and gets out, that you've actually made all that profit, that you've made $700 profit? No, you haven't. It's not in your bank account. That's a relief trade. All you've done is get relieved from that bad trade. That's not making a profit, is it? So why would it be making a loss if it does the other thing? So when it goes up, move your stop loss up so that it's at break even or just into the profit or whatever. Now it moves through and it keeps on going up. It goes up to 1,000, 500, 1,200, somewhere there. Then just start moving the stop loss up into profit, $500, $600, and follow it behind. When it gets to your target level, you don't have to take target. You can move the stop loss right up behind the $2,000 to say 1,900. If it comes back and takes it out, bully for you, you've pretty much made target. Or if it keeps on going north, then you make more than what you expected to in the first place. It's better never to just trade out of a trade. But if you do take your profit at target level, there's nothing wrong with that because all the money behind that wasn't yours anyway, so it's fine. And that's how you trade. And that's as simple as the system gets, or the strategy. The squiggly lines are not going to make you your money. They're never going to make you your money. The squiggly lines are there to give you a high probability trade. And, you know, some of you might want a win rate, so you'll make $10 on every trade and then lose 1,000 on one, and then you'll be able to boast that you've got a win rate, but you'll be making a loss. So, you know, that's entirely up to you at the end of the day. But what you actually need is to be able to become a profitable trader. And the only way to do that is to have a strategy like this. The squiggly lines will give you your probabilities, but they won't give you your wins. Your wins are up to you at the end of the day. By taking more of your winning trades and following your winning trades and not following your losing trades like you always do. That's why you're losing, because you're following the losing trades. Most of your losing trades become relief trades. You know, when it gets back to cost, you go, let me get out of there. You got your money back. You know that feeling. You all know that feeling. I know you've all been there and you've all done it. So guys, remember, when it comes to real money, the market changes completely. Anyway, I hope this video helps you, and I hope the moving average crossover system will stick in your mind, but you don't have to use it. You can use any system in the market that you want, but you know that I prefer the price action systems in the market. Those are the ones that keep us going. And if you want to know more about price action and how we trade it with no indicators, go and watch this last video and it'll tell you how to do it. Guys, thanks for watching. Don't forget to come back for the live shows. Till next time, cheers, thanks, and bye.